Good evening and welcome to SCOTONOMICS episode 108. And we've got a fascinating interview that I did with David Blanchflower, who's economics professor at an Ivy League college in the States and was also a member of the Monetary Policy Committee at the Bank of England. I spoke to him for over an hour and we decided to break these interviews into two. This one exclusively concentrates on his time at the Monetary Policy Committee at the Bank of England, and it's fantastic. It really is a real kind of warts and all look at that institution and the impact it has on our economy and our society. So that'll be with you in a couple of minutes. It's just myself this evening, and Kieran's got a council meeting the last Monday of every month, so she's unable to join us tonight. So welcome to everyone who is able to join us, people on Facebook, YouTube, and also Twitter, and some on TikTok as well. So thank you very much. Any comments and questions you have for the interview, to cover the content for the interview, please do drop into the comments. Anything you want to mention before we get started? I'm sure you've all seen the return to austerity, which was announced by Rachel Reeves today. Austerity comes in a different form now. It comes under the idea of fiscal rules, but it's exactly the same process and the same end result, which will be the poorest in society paying for things which allows the wealthiest in society not to do that. So austerity's back. I'm going to write about this in detail for our newsletter for the National tomorrow, which is also available first on our Patreon site. So yes, fiscal rules, it's just another word for austerity, and I'll be diving into that a little bit deeper in our article on Patreon and also released on the National. Okay, well, we've got a wonderful interview with Danny coming up. So it's round about 40 minutes. I'd love to hear your comments on this because it really is a fantastic interview. And please do drop anything in and I'll get back to you during the interview. You're really going to enjoy this. I'll see you in about 40 minutes time. So I wanted to start with your time on the MPC, and it was between June 2006 and May 2009, which of course covered the period of the financial crisis. Now, this was undoubtedly a very interesting time to be at the Bank of England, but before we discuss the kind of policy responses, I just thought it'd be interesting for our listeners and our viewers to find out why you were there for what seemed like a relatively short period, a bit more about the background, why were you selected for the MPC?
Obviously, you'll have to ask Gordon Brown and Ed Balls, but I actually knew Ed Balls quite a lot earlier. He was one of the FT correspondent, he used to talk to me a lot and ask me questions. So I spent a lot of time talking to Ed Balls, but in a way, my experience was I did cross-country comparisons. I was interested in labor markets. I was interested in capital constraints. I was interested in particularly US, UK comparisons. So I was a sort of a surprise. I got a call from Lord Macpherson, who was essentially Sir Humphrey, if you think back to he was the Gordon Brown's permanent secretary, and asked me if I was interested, and I hadn't really ever had a thought about it. In some ways, I do recall that people were asked, could Danny stand up against Mervyn King? Which, well, I was told that was a question people had asked. And in the end, that was a really big deal. So I went for 3 years, but basically I had family in the United States. I had kids going to college, and Dartmouth were very kind and gave me 3 years leave. But I was not going to give up an endowed chair at Dartmouth to stay for any longer. And also it was absolutely dreadful. It was an absolutely terrible experience, especially for nearly a year. I voted on my own, and all the other members of the committee voted against me, and I was excluded from meetings and treated as a pariah until suddenly I wasn't. And the big deal was Gordon Brown called me up one day and said, Danny, I know there are 9 opinions and you're losing 8-1, but actually there's not 9 opinions. There's just 2, yours and theirs. And I think you're right, which is actually a big deal for me. But I mean, I had a lot of support in the end from Gordon Brown and Ed Balls later. But it was a dreadful experience. And in a way, I mean, I remember Rachel Lomax said to me, the biggest mistake people made was not listening to me about America. Because I lived in America, I came back and forth to the UK every 3 weeks. And basically what I saw was a collapse that occurred around me in the United States. And essentially 6 months later, I started to see the same thing in the UK. And somebody who lived and traveled between them They should have basically listened to me. And I gave a speech in April, on April the 28th, 2008, where I said the US went into recession at the end of the year and the UK is in recession now. And everybody said I was nuts. But if you look back at that speech, it's 100% right. And so the way to think of it is that by September, really October 2008, September when Lehman Brothers failed, October when RBS failed, the members of the MPC had still not worked out that the US had been in recession for 9 months and the UK had been in recession since April. So this was pretty appalling. And I was just shocked that they all didn't resign afterwards, having missed the Great Recession, the greatest shock in 100 years. And the 8 members of the committee entirely missed it. And it was an awful time for me. And my daughter was at St. Andrews at the time. And she called me up one day and she said, "Dad, I've just read a thing in the newspaper which said you're an idiot without a village." And so, it turns out that I had a big city and the rest just got it wrong. And so, and obviously that was a giant fight. It was awful to watch. And I felt a huge responsibility. And in some ways, people said to me it was my fault for not persuading the others. And I guess there's some truth to that. But my experience was looking at capital markets, what happens when banks fail, when capital constraints occur. And I'd done a lot of work on that. And I'd done a lot of work on US-UK comparisons. And essentially, Mervyn King was arguing all the time that the US was irrelevant. And I said, that's the most ridiculous thing I've ever heard. And I gave a series of speeches countering what he said. And I essentially in that speech rightly said, when the US sneezes, the world catches a cold. So this is pretty interesting. Gordon Brown and Ed Balls backed me, and so did Alistair Darling. And it was a sort of a dreadful time. But if you look back, this was the expertise that I had. I looked at the US and the UK, and I looked at the data. And other members, certainly in the committee, argued things like the collapse of the housing market wasn't coming. It didn't really matter that house price to earnings ratios were unbelievably high, and learned nothing from 1926 through 29, where the housing market collapsed in the United States and generated a crash and a Great Depression. So I thought it was a sorry time. I was highly isolated. It was hard to speak up, and it was the tyranny of the consensus. But I look back as a dreadful time, and after 3 years of it, I was done. Alistair asked me, would you like to stay on for long? I went, no.
A short conversation that was.
Alistair, much as I like it, there's no way in 1,000 years I'm going to do that. It was a dreadful time. And actually, Gordon Brown called me up and said, I'm really sorry for appointing you and having to do that dreadful job. Bless his heart. I think Gordon was fantastic, saved the world. But, so that was tough times. And I think people in the UK suffered terrible consequences because of it. And then you ended up with lunacy, absolute lunacy, which is the world. Eventually, the central banks get into the business. Gordon Brown steps in and does all kinds of fiscal stimulus. And then you have 2010, where the Conservative government goes completely bonkers and doesn't learn that in a recession, public spending crowds in private spending, and it goes to austerity, which I thought was absolutely an atrocious.
But hopefully we can kind of look at that kind of austerity period as well. But it seems like you were definitely an outsider before, and then even more of an outsider when you were actually inside the Bank of England.
Right. I mean, I got to the committee at one point. I recall I was the only person on the committee who hadn't been to Oxbridge.
Yeah.
And in a way, I was a data guy. I'm a data guy. The other people are not data guys. And you want a data guy. You want a guy who understands how markets work, looks at the data, looks at things that are going on, and tries to think about what was coming. And so I look back, and my expertise and experience was exactly the right one you needed to do these cross-country comparisons. And not just the MPC missed there was the Great Recession coming, but they missed what happened in America was spreading. I'll tell a little story. I gave a big presentation to Dartmouth students at the Bank of England, and I was talking to them, and I sort of thought to myself, I just realized that the Dartmouth students in the bank in the city of London, in Canary Wharf and around the bank, were all the same, were working for the same institutions as when I gave a talk in Wall Street. So they were all working, for the same banks. And if you thought to yourself, well, there's a financial crisis in America, you've got Bear Stearns, and you've got all sorts of things going on, it'd be pretty unlikely that the financial crisis in America was going to remain in America when all the same financial institutions were in London. That was an insight for me. and it struck me as kind of nuts. And of course, you find that it's Northern Rock, Bear Stearns, Lehman Brothers, and then RBS, and then Lloyd's. Again, you know, MPC, Mervyn King and Paul Tucker missed the failure of RBS. They missed the failure of Lloyd's. They didn't know that was coming. They didn't know the country was in recession. How they ever just didn't resign, I have no idea. I would have.
Yeah, I think you can certainly say that about the whole of the economics establishment who were in charge at that period of time. Looking back at that time, my kind of understanding is that a lot of the data that you were probably presenting wasn't data that normally went into the economic models. So, you know, this underlying asset prices and the kind of over-financialization, these weren't kind of data points for these models.
Yeah, they were. But I mean, increasingly, I've sort of thought about the 1920s. And I kind of have right now, I have in my head. So if you think back to what the precedent wasn't what happened between 1945 and 2007. The precedent, if you look back, was actually what happened. Well, think about it. You had a 1916, you had a Great War, you had a pandemic, and then you had a financial crash. But eventually we've had all of those things. And the reality is that the Great Depression started in the Florida housing market. And the Great Recession started in the Florida housing market. It started in Florida and Nevada and California and Michigan. And so there were a number of issues. I mean, I've learned a lot more, which is actually I have a house in Sanibel. We got hit by a hurricane. But I also realized that shocks are pretty important. And now I am taking the view that the 1926 hurricane, which hit the Southeast Florida and wiped out 30 miles of coastline, actually basically weakened the banks to such an extent that then when the financial market crash comes, the banks are just really weak. And it made me start to think that central to an economy is what happens to the banks. I mean, if you look back, it turns out that in the 20s, regional banks in America were a really big deal. So I think there was precedent. There just wasn't precedent between 1945 and 2007. And people didn't look to the reality. Where was the great crash coming? And they, I mean, the forecast, in a way, they got complacent because growth had occurred every quarter, really, for a decade. Every quarter had positive growth. And so what people were sort of assuming is that growth will just continue. And those models are fine until they're not fine. And what do you end up doing? You end up, think of a downturn. Well, you end up, when a downturn comes, you just keep on assuming the trend you'd had continues. And that's what happened. And a lot of time at the Bank of England, we'd have these discussions, and the bank's agents would say entirely different things to what the economists were saying. And I used to say, well, we should listen to what I call the economics of walking about. And that's not what the economists or the members of the MPC were doing. But it turns out with hindsight, that's what they should have done. But again, the economics hasn't really got to grips with all of that, because think what happened between 2010 and 2020. And then we get to 2020 to 23, we get the Bernanke review, talks about the failure of forecasting. Well, the failure of forecasting, the same forecast didn't actually forecast the coming of the Great Recession, even after it had come. So the August 2008 inflation report talks about there'll be no recession. Well, how ridiculous is that, given that the country was in recession in April already? So they couldn't even work out where they were, couldn't work out where they'd been, and and the forecasts were completely hopeless. So I think the Bernanke review is interesting, but it was really about, we should have had a Bernanke review in 2010, which said, why did the forecast miss the Great Recession? Nobody at the bank ever asked me. Nobody on the bank directors ever asked me. When I was there, they never came and said, well, how come, Danny, you disagree with everybody? How come you disagree about everything? And the answer was groupthink. And of course, with hindsight, they should have come and said, well, how come nobody listened to you? Because you were right and they weren't. And so I found it, disconcerting, and it doesn't surprise me that Bernanke is right, that you should have started to think about scenarios. But the reason in the Bernanke review we get to where we are is that they should have been thinking about this in 2017, 2014, 2010. And they should have started to think about, forecasts are complicated, especially when things are kind of changing, and you need to think about what scenarios there are. So I think what we've seen is really the Bank of England has been completely hopeless, really, from 2006 or so. And in all probability, if they hadn't existed, well, there's one thing I would say. The problem has been membership, and I think central to what we should have seen. We should have seen representation from Scotland and from Ireland. and from Wales, and we should have seen regional representation. We should have had people with differing views. So there weren't just 8 clones, there were 8 or 9 clones.
There's the MPC,
I mean, you have
MPC
clones.
itself, yeah.
But, I mean, Alex Salmon and I years ago talked about this. I would certainly be of the view that if Scotland becomes independent, 2 possibilities. One is you have your own central bank. Another possibility is you have your own currency. But a further possibility is that you demand and get representation on the MPC. Why not have 4 members of the MPC, or 5, where one's from Scotland, one's from Ireland, one's from Wales, and one perhaps from the north of England, and the governor, and that at least would and that could perhaps be appointed by the Parliament or appointed by the First Minister or something. And I think that would have been a hugely improved position, because you basically had groupthink.
Yeah.
Think about where everybody who's been on the MPC has come from. They've either come from the city, they've come from the Treasury, they've come from some university in London, they've come from some financial institution in London. They all live in London and the southeast, apart from a few like Adam Posen and me and a few others who come from outside. But so I think we can have a conversation about whether Scotland should have its own currency and a central bank. But at the very least, that it needs a representative on the MPC can represent the views of Scotland. And I think if there have been people on the committee saying, look, this is what's going on in Scotland, this is the economy's in trouble, that people didn't do the economics of walking about. They lived in London and they got on the train and they went to the bank and they just believed what that nonsense they were told. So I think the Scottish impact and influence is a big one. And I remember giving a speech in Edinburgh in April 2008 and talking to lots of insurance folks who struck me as being much more on the ball than people in the City of London. So you want to hear about the people's views in Edinburgh and Glasgow and elsewhere.
But I agree with all of that. And I think that kind of adds on to this point about the data points. Data points being the housing market or the state of banks, but also the data points coming from other parts of the country. It's just not fed in.
Absolutely. I mean, in a sense, if you have a central bank setting interest rates, that's in a sense an alternative to regional policy. And maybe what you actually ended up having was rates were too low in London and too high everywhere else. I mean, imagine, right? So you don't have a regional policy, but why would you not want to have people with, I think you should have fewer members, more power. They can't be controlled by the governor, and they represent the views of the people. Think of Northern Ireland. Northern Ireland, the economy there is in a different situation to that of London. And what we've seen is, in fact, the government's in deep trouble because it hasn't actually understood that what happens I talk about the woman on the Mile End Road omnibus. In a sense, it could be the woman on the Edinburgh bus or the Glasgow. But the reason I like the woman on the Mile End Road omnibus, my daughter was born at the London hospital. I did a PhD on the Mile End Road. But the Mile End Road is really interesting because it's 1 mile from Aldgate. And there are 2 worlds, right? So the City of London, 1 mile away is the Mile End Road, and it's Whitechapel, and it's it's the East End of London. And the question is, what happens to the ordinary person? What happens to the person in Scotland? What happens to the person in the Outer Hebrides? What happens to the person in Belfast and Cardiff? And that's what's happened. And in a sense, that the way that economic policy has gone is part of the reason why the government's in such disarray.
Yeah,
because they haven't understood the levelling up thing was all nonsense, and they haven't understood that that there has to be regional representation, but there has to be regional representation in terms of inputs to monetary policy. Yeah, and Andy Levin and I are writing stuff about that right now, trying to think about what you should do. In a way, think about Labour government came in 1997, and what did Balls and Brown do? They made the Bank of England independent. So we're kind of thinking, well, what should the new, presumably Labour government do when it steps in? What should it do now it's got, now we're whatever it is, nearly 30 years later. And I think fundamental reform should take place. And there has to be a thinking about, well, if there is Scottish independence, what should happen? And I don't think it's clear. But at the very least, I would argue that a price that in a sense, the price that if people who want the people who don't want independence may have to pay the price, which is okay. If you don't go independent, we'll give you big representation on the MPC at the very least. That might be.
I don't want to go too far off topic, but that's kind of similar to the situation we were in 2014, where we were promised, by Gordon Brown as close to, all these things were kind of made just before, and then also, just before and then and it completely changed. Yeah. So, but I'm definitely in agreement with the need for reform.
What if we were to be the advisors, what would we recommend? And we would, obviously the Bernanke review has already stepped in and said the Bank of England is not fit for purpose. And the MPC, in my view, is not fit for purpose because it has, in a sense that it's clear what this MPC does. It represents the interest of banks. What about the interest of ordinary people? What about the people? What about, what we've seen is, the actions of the MPC by doing things like quantitative easing and so on. What that did is it raised the wealth of wealth holders. If you owned assets, it raised the value of your assets. But what about the people who didn't own assets? So what happened is the bank helps all those folks, and then the government decides to go to austerity. So what you have is life expectancy of the poor falls. The NHS is in deep trouble, and the wealth rises, and now you have this. So I think this is all part of the reforms that are coming, and why this government is, 30 points behind in the polls, something like that.
Yeah. In kind of terms of reforms or looking at a different way of doing it, I just wondered, to say for the viewers in the audience, that central banks tend to increase interest rates in the hope to reduce inflation. And then inflation, they believe, is going to temper demand. But this often leads to increased unemployment. So effectively that interest rates up, inflation down, unemployment up. Is that a fair summary of that basic framework of central banks?
And in a sense, the mistake that I and others made was in recent times, we assumed that raising rates, especially in the United States, would have much more of an effect on the real economy and raise unemployment more than it has. And I would say since 2020, that is really a puzzle. How come when you raise interest rates from next to nothing to 5.5%, the US economy has not really turned down and unemployment's remained below 4%. To some degree, the UK has obviously been in recession, but it's a sort of technical recession, slight recovery, but basically weak growth. But you would have thought that based upon, well, first of all, based on interest rates, and second, based upon people's views of the economy. So consumer confidence is a big deal. People say their confidence in the economy is weak. It predicts recession. It predicts them stopping spending. That hasn't happened. Why? Well, some of it in the United States is my kids are in this position. They took out loans in 2015 at 2%. So the raising interest rate has no effect on a 30-year loan that you took out in 2015. And then second, there's all these people, and certainly in the UK context, who already own without a mortgage. So that's some of it. And the other thing, in a way, is why have people kept on spending when they say that, they think the economy is, the consumer confidence levels in the United States over the last year or so are entirely predictive of recession? I think the answer might be that they have had an experience in COVID where the government steps in to rescue them. Maybe that, but obviously the story has been raising rates has not tanked the economy to the extent to which you would have thought. And now, because of all that, and because inflation has remained relatively high, the expectation of cuts in rates has diminished. I mean, earlier in the 6 months ago, there was an expectation this year there'd be 6 rate cuts by the Fed. Now, perhaps we're down to 1. So this is obviously a puzzle the world doesn't exactly know. We're less interest rate sensitive than we have been in the past, and we don't really know why. I mean,
would it be fair to say that? I think there's certainly a different approach and understanding to the role of interest rates and inflation within the heterodox economics, which is to say that monetary policy doesn't really have that much impact. So you're starting from a very different position. I'm not sure.
That's the reality. I mean, the reality is that cutting rates and doing QE in 2008 eventually generated a big comeback, generated a great recovery, which was killed by Osborne the second he put in austerity. So the economy was growing nicely. And then for a decade, you had flat growth rates, which ended up causing Brexit and all the rest of it, because he idiotically went in and cut public spending. And what is it? What do people see now? It made them vulnerable to COVID. It's impacted the NHS. So I think, that's probably the worst economic decision other than the vote for Brexit. But the worst decision a chancellor has ever made is the move to austerity by Osborne, which basically what it's done is it's killed poor people.
I think there was 300,000 excess deaths were linked.
I think that. It's also true there's no economic basis for it, and we know from Thomas Herndon and all the work that he did, that the arguments that it was about what Reinhardt and Rogoff has said about, you had to get debt to GDP. It was all just nonsense. It was spreadsheet error. It was either a statistical error or it was fraud. It was one of them. I don't know which it was.
We've covered before, there was 3 kind of papers that Osborne has linked to, and I think Osborne wanted to appoint Rogoff to one of his economic advisors around that period of time. So they were just waiting for an excuse to reduce welfare.
They wanted to reduce public spending. They wanted to try and make the poor weaker, weaken their bargaining position, and be able to give tax cuts to the rich. But the basis of this whole argument was found by Thomas Herndon. I got him to come and show my kids in my economics class at Dartmouth. He came and he brought the spreadsheet. And basically what you see is essentially the entire thing was based on a column of data where the bottom part of the data was countries that had high debt to GDP ratios and high growth. And literally the entire thing was based upon, he summed up 2/3 of the column. He went, okay, so my students sat there and went, oh, well, let's just sum those ones. Well, the entirety of Osborne's economics and Reinhardt and Rogoff collapses. And so there's a great program viewers can ever watch, which is called the Colbert Report, where you have Thomas Herndon on. It's great. Maybe I'll give you the link and you can link to it. But it's basically, this is literally they couldn't add up a column of data. That was the basis upon which Osborne, and he talks about in his May's lecture, he talks about how important it is to get debt to GDP ratios down, and ignores the fact that if you take out all this public spending in an economy that's starting to grow, essentially every recovery you've ever seen, the economy grows steadily out of recession. It was growing steadily. Osborne comes in and kills that growth dead for 10 years.
Yeah, there was a significant underestimate of the impact of the multiplier by government spending as well.
Right.
So there was other things, but as I've said in a previous interview and a post I wrote, it was like they were just waiting to find anything to support the argument, and there was no due diligence at all. And I'd kind of said, we're in a situation now where you would hope that they would be open to new ideas, but only if they back up that kind of conventional wisdom and take them in the direction that they want to go. Before we finish on central banks, a very specific question then. Some people within MMT, Warren Mosler is probably the best known, has been saying for a long period of time, actually, but certainly over the last couple of years, that it's likely that the high interest rate payments on government debt is actually fueling inflation, or partly fueling.
I don't know. I think the jury's still out on that one. I don't really know. That's a debate that people are having. There's a story about why it is that inflation remains so high, and the jury is still out. I just don't know the answer to that. We know there's a debate. In a way, the thing that I could give to you actually usefully is that when we went in the fall of 2008. And by which point I'd managed to get the MPC to come around to my view. And in November 2008, we cut rates by 150 basis points, and then we kept going. And by that point, we realized that we were going to have to do quantitative easing. It took until March to do it. But the reality is we had no idea how to do it and what its impacts would be. But let's keep going. So then if you have no idea what happens on the way in when you do it, central banks and economics, there's absolutely no clue as to what happens when you start to do quantitative tightening. What does it do? What impact does it have? So you pay interest on the debt, you start to cut it, you're doing the reverse. This is literally finger in the air and trying to test the wind. They have absolutely no idea what the consequences and the impacts of it are, and have done very little studying of it. And so you might think that perhaps this quantitative tightening is having effects that we don't really understand. By which I mean, instead of buying assets, you start selling them. And so I think the answer is I'm going to pass on it. But the answer is they don't know.
Yeah,
so
and I think
it's as if they have certainty about what is going on, and they absolutely don't. That's the
no way. And and when I looked at the Bernanke review, I was hoping to see things like you need to use stock flow consistent modeling. You need to use different types of models so that you're getting completely different results, so that you can kind of look into that in a little bit more detail.
He talks about the fact the models don't work, but doesn't actually. It's not like going shopping, right? You go to the shops and you say, okay, this hairdryer doesn't work. I'm going to go to the shops and I'm going to buy another one that really does work. It's like, well, okay, he says you need to get new models. Well, the problem is there aren't these models. You can't go to the shops and suddenly go, I'm going to, there are lots of alternatives available. The Bank of England has not been sorting things out. But let me give you a little story, something which will shock you. Maybe it won't. I remember, and I've been involved in these models. So I started to look at the models, and I'd been a modeler for the very beginning of my career. And I said to the team, so it looks to me that an awful lot of this and the models that you have are based upon let's call them judgments. So I said, will you tell me which of the judgments is really driving the forecast, and what happens if we take the judgments off one by one, and I can work out, it's not that the model doesn't just estimate and give you an answer 3. The model says 422, and you say, oh, well, let's fix it to 3. And so Mervyn King would never let me have that question answered. I have no idea. So the truth is, it's not just about the models that are running. It's models that are running with judgments. And we sit in these meetings and go, well, we don't like that. We'll move this here. So it's not even that. It's not even which model you have. It's what's the role of judgments, right? And judgments mean you can't allow this bloody thing to run because it's going to give you an answer that's stupid, right? So you'll say, what's the growth rate of something? And the model comes back and says 8 million %. You say, oh, it can't be. That's got to be 2. Right. And so there aren't models that you can pull off the shelf. But in a sense, your things about MNT and other stuff is that the reality is that economics has not confronted itself with the real world enough. Right. Bernanke wants better models. Well, from where? Where are those going to come from? And the Bank of England says, well, the Bank of England's got to go get lots of resources. Well, why didn't it do that in 2010?
I agree with you. It's the variety of modeling, but also the perception. I mean, what would a feminist economics model of the economy look like, and what would that tell us that we need to do?
And would it be better than imagine here are 15 different models, and the question is, let's go do a set of tests and have a horse race, right? Okay, there's all these models. Which one works? What should we do? If we do that, and what's the role of judgments? I mean, go back to literature so the listeners understand. You run a mathematical model, it produces an answer, and you say, I don't like that. And the thing forecasts 8, and you say, I don't like that. Let's wing it and call it 2. That's what the MPC does. That's what it does. It just makes stuff up all the time. So it's forecasts. I mean, essentially, if you think of the way the models work, and they've banned the fan, Bernanke says the fan charts should go, well, the models say that actually, all these models say that in the forecast horizon in 2 years, inflation will come back to 2%. That's what the basis of the model is. Well, why would you believe that? Certainly hasn't come back to 2. That's why so the answer is that this is, modeling the economy makes makes astrologers look good, right?
And of course I think we need to finish there by saying it's an incredibly complicated task to try and manage one of the most dynamic systems.
And the answer to that, why Bernanke is so sensible for the listeners. So think about, you run this model and you say, okay, so what's going to come? And you say, well, what if the war in Ukraine ends? Or what if the war is bigger? Or what if there's another pandemic? Or what if they discover oil in the North, whatever. So let's call those scenarios. So the question is, are you going to forecast the probabilities of these scenarios? No. So what Bernanke says is, okay, so let's run our models, but let's think about 4 or 5 scenarios, which is productivity goes up, productivity doesn't go up. There's a new government that does X and Y. And so that's the world we're going to have to go to. because these forecasters can't predict. I mean, they didn't know the pandemic was coming. They didn't work out that the banks were going to fail. So what they should have been saying is, I mean, what Osborne should have said in 2010 is, I'm going to do this, and my forecast is that everything's going to be hunky-dory. Well, what if it isn't hunky-dory? What if productivity doesn't rise as I forecast? What if it remains flat? Or what if it falls?
I think this is definitely the thing I'd like to see within those types of modelings is making it humanize them. Who actually pays the price under this scenario? If the economy does grow,
but then go back to what we were saying. Think about if you have 3 or 4 members of the committee who don't have to all agree on a forecast, and the Scottish member of the MPC says, you know, a scenario which would be really disastrous for Scotland would be this one. It may not be disastrous for Northern Ireland, but this would be disastrous for Scotland. And we have to do special, you know, so that would be a perfectly reasonable way for a member of MPC from Scotland to say, you know, if this was to happen, this would be bad for Scotland. And, you know, and so the scenarios, I mean, that's what Bernanke has said.
Yeah.
And in a sense, it's a pox on all your houses, on all the modelers' houses.
Yeah.
You've got to start again. And the way to start again is to allow sensible people to come in who understand local economies. Again, think of the economy of Scotland. They understand Scotland, and they're going to try and do things that make sense in Scotland. Anyway, we're on the same page here, but I think that's a new world, and I think that's what the Labour Party is going to have to start to think about, as is the Scottish government, and you know, all thoughts about whether you want to have independence are going to be all intrinsically linked with all of this.
The last question I wanted to ask you specifically on central banks was, you know, over the last 12 months, and I've been kind of highlighting every month the increase in the amount that has been paid, interest has been paid on government bonds. For the last 12 months, it's round about £150 billion that's been paid as interest. Now, much of this finds its way to the already wealthy. Is this an acceptable outcome to try and use monetary policy to control the economy when this is what happens?
Yeah, I mean, the question whether it's acceptable. I mean, the first thing is, I said it before, it's unclear exactly what the effects of all this are. But then monetary policy is not independent. I mean, I remember hearing Janet Yellen talk about the fact that, okay, if you set in and there are a limited number of things central banks can do. For example, in the US, they went and bought MBSs, mortgage-backed securities. And obviously that's going to have an impact on wealth. But what can the MPC do about it? Well, that's the job of the Chancellor. That's the job of the Prime Minister to do things. So what you've seen is this dramatic rise in wealth inequality. You've seen the difficulty people have to get into the housing markets and all of that. But that's, in a sense, that the central bank can only do so much. This is the responsibility of the government. And over 14 years, this government's decided it wants to allow inequality to boom, and it thinks that, you know, trickle-down economics has worked. And the evidence in the polls and the evidence from the National Health Service and declining life expectancy and all of that suggests that the public don't like that. But what's happened is that it's the policy of this past 14 years of this government to allow inequality to rise. And the central bank has done what it can do, because there's only so many things that it can do. But if it then raises inequality, the way to fix it is for the government to step in and counter it, and it hasn't done that. And so therefore you have, you know, people pretty unhappy about what's going on, because they see the gap between them and the Tories and their rich pals as being unacceptable.
And what we're seeing as an independent central bank tries to cool down the economy, which means poor people tend to lose their job. And while they're doing that, they're putting a huge amount, you know, 150 billion over 12 months into the already wealthy. That's what we see the central bank doing. And I'm sure, you know.
Well, I agree with that. Yeah, I mean, I've written stuff about, so people argue about how terrible inflation is, but the question, it turns out that unemployment is actually much worse. But I mean, the evidence in terms of well-being, lots of people have studied it, and the evidence is that a 1 percentage point rise in unemployment is perhaps 10 times worse in well-being terms than a 1 percentage point rise in inflation. And it's not to say that inflation doesn't hurt people, but it turns out that a rise in unemployment, think about for ordinary people, so a rise in unemployment for the members of the MPC has no effect at all.
Absolutely.
They don't care. They don't get to be unemployed. They don't walk Sauchiehall Street. Their kids aren't unemployed. They're all fine. So they care about inflation because they care about the banks care about it and all of that. but ordinary people are impacted by what happens in the labor market, and there's the dilemma. And so the answer is that all this guff about inflation being the major thing, actually activity, economic activity, and unemployment, lack of jobs, underemployment, all of that, low wage growth, that's what hits ordinary people. And that's why this government is 30 points behind in the polls, because people have had enough.
Fantastic.
And I think it's a sensible economic response to matters. I mean, Brexit ended up, you made all sorts of promises, and it's now obviously disastrous. And 3/4 of the population think it was a disaster. And, anyway.
We could have definitely had an hour alone on Brexit. Fantastic.
I gotta go.
Brilliant. Danny, thank you so much.
Well, I hope you enjoyed the interview. I actually watched it last week, and I sat through the whole thing as well. I think Danny makes some absolutely crucial points, a few that I've tried to pull out in the comments. I think the first one and the most important one for me looking forward is the role of the Bank of England in the current plan for the currency after independence. I had a little conversation with Karen in the comments. My view is that the Scottish Government's plan will see us using sterling for at least a decade after a yes vote. Considering that a transition period is likely to be about 5 years, maybe longer. Brexit was just under 5, might be a little bit longer. I think the conditions that we've put in place, what the Scottish Government put in place before we move to a Scottish currency, takes us to at least a decade. I'll put the link on the article that I've written. I've kind of gone in a lot of in depth to explain why that. I think behind the scenes, the Scottish Government wants to move from sterling to the euro. I think that's the position. I would love to be able to have this conversation or hear an opinion from someone within the Scottish Government to explain the reasons for those conditions and how they speed up our transition to a currency. I think they slow it down. So certainly that's one thing I'd really like to make an important point here, is that the Bank of England will have a significant role in Scotland's monetary policy after we become independent, after the transition period. And I think this kind of almost whistleblower interview shows the huge issues we have. It is completely London-centric. It's not even England-centric, it's London-centric. And already we're in a position where interest rate decisions are made on what's best for the City of London or London and not the UK. If Scotland's involved in some kind of pseudo-currency union, there's absolutely no way that the Bank of England would even give the slightest bit of concern for the Scottish economy. So I think this is a huge issue. And of course, the Bank of England reports to the Treasury, which is a function, or which is a department of the UK government. So this idea of independence without monetary independence, I think is exceptionally dangerous. And I think if you look at this kind of behind the scenes of what happens at the MPC with the models and the decisions and who's on the MPC, I think it adds a lot of evidence to the discussion, or certainly my argument, that we should move to a currency as quick as possible. I think the second point that I think is really important is the role of interest rates. We had a conversation with Danny there about what impact they're having on the economy. The orthodoxy says that you raise interest rates and the economy slows down, inflation falls, but that's not happened since COVID. So a real kind of head scratching going on in the orthodoxy. And as I said in the comments, heterodox economists have been saying for years that this relationship is much more complicated than that. The idea that you can just move one factor in the economy and everything else will shift into equilibrium is just not something that seems realistic or is backed up by the evidence. And then the third point I would like to highlight was Danny's point at the end, where he said, yeah, inflation's bad, we need to think about that, but unemployment is much worse for the economy, and of course it's much worse for the individuals who lose their job. And I would like to see a central bank, I'd like to see government policies that focus on full employment. That's a job for everyone who wants one, and that to be a dual mandate, or maybe even a part of a mandate that's got 3 or 4 conditions for a central bank. So completely different from the mandate of the Bank of England at the moment. And it was really interesting to have Danny support that as an ex-MPC member. Danny's done loads of work over the last couple of years on well-being. He's kind of left this MPC life behind him, but I think it's really important that you have a look and see all the work that Danny's been doing. I'm going to just look at a couple of the comments and questions. Thanks very much for them. It's just myself tonight, so I'm speaking and I'm doing the questions, so give me a second. Karen, I'll send a link to that. The conditions, I think there's 6 conditions that the Scottish Government have said that have to be, that we have to kind of like tests that we have to pass before we move to our own currency. I don't think those are economically or scientifically grounded. I think some of them are complete fudges and you can change the perception of them. I think this is designed, as I said, to ensure that Scotland takes as long as possible to move to its currency in the hope that we can move to the euro. That's a very personal opinion from me, but I think the economic argument is really clear. Those conditions do not translate to any kind of economic theory that suggests that's how you move or the best way that you move from using someone else's currency to your own currency. But thanks for that. Maybe I'll do an episode on this in detail when we're back in September. When will the Bank of England implement their digital currency, Mr. E? I know there's a working group within the Bank of England working on that at the moment. I actually have someone who works in the Bank of England, and they're saying probably about 3 years before that's likely to come into kind of any kind of meaningful existence. But it's certainly something that I think is really interesting. Also know there's a group within there who are writing about this, and it's going to be really clear that they'll come out and they'll have to say that all currency created, all spending, all government spending is digital, and that currency is created when the government spends. So that's going to be something that's really, well, we hope, supportive of MMT. So I hope that answers your question. I've got a little bit of insight into what's happening at the Bank of England. Let's see. We don't want a repeat of the Darien scheme. Yeah, I think a 350-year-old reference is not particularly useful at this point, but we'll see where we are. We need a new sterling, but we definitely need a new currency, but sterling is Scotland currency, not England. Gabby, we've probably got time for you to explain what you mean. Sterling is issued by a government agency, a UK government agency, which is Bank of England. Sterling is 100% a currency of the UK government. We use it in Scotland. Some of our commercial banks are given a license to use currency with their names on it, but it is absolutely 100% a currency issued by the UK government. It has nothing to do with Scots, nothing to do with the Scottish government. I think a real deep understanding of what currency is will really help all you viewers who are not too sure on where we are with currency in terms of moving forward. If you really understand that the currency is issued by the UK government, it's created by the UK government, it has nothing to do with Scots or Scotland. I'd love to go into that in a little bit more detail. Thanks for all the questions. I'll see where we are. Northern Ireland uses 2 currencies. Yes, the people in Northern Ireland use 2 currencies, but the government only spends 1 currency and only taxes in 1 currency. And this is the absolutely crucial role of currency. The UK government spends currency and it taxes currency, and it spends pounds and it taxes in pounds. So this is where the true value and use of a currency comes from. You know, you can use that extension, Kevin, to anywhere. You can use as many currencies as you want, but the currency that controls how an economy works is the one that's issued and the one that people have to pay tax in. So it's very different when you're talking about who uses a currency and who issues a currency. Yep, I think that discussion about Darien is interesting. I'm sure you can have that on another platform or continue on this without any problems for me. And then you got, yes. So I think that's probably where we are. Just to let you know, we're actually going to have August off and we're going to be back with some episodes in September. And hopefully I'll be joined a bit more regularly by Kieran, because it's difficult doing all the buttons, doing the presentation and doing the questions and answers as well. But thanks so much for the engagement tonight. Please do like and share this episode, because I think it's essential that people understand how the Bank of England works at the moment, and especially really important for people as they consider the role of the Bank of England once Scotland becomes independent again. So thanks very much for joining us. I'm just going to see Kevin. Yes, you can be taxed initially on the UK pound, then move to your own currency. Yes, of course, you can do whatever you want with currency once it's your own. The important point is that currency is accepted in a country because there's a tax liability. And if we move to an independent Scotland and the tax liability lands outside of the control of the Scottish Government, then the importance and the value of that currency remains in Westminster and not in London. I've got kids in the background you can probably see running around. I'll see if I can do these last couple of comments. Yes, there are Scottish, as you said, Gabriel, you're correct. There are notes with Scottish details on it. But as I said, it's the currency of the Bank of England controlled by the Treasury and the UK government. It's not a Scottish pound in any kind of meaningful, realistic way. And fiat currency is only valid as long as there is faith in its value. Mr. Yeah, I would agree, but there's a huge amount of value that comes from the need to pay taxes, and this is a kind of staple of modern monetary theory. If you don't have to pay tax in something, then you're less likely to find the value in it. So it's almost a little bit of a kind of stick mentality to ensure that your currency is accepted and you're able to provision yourself. I've got a wonderful article I wrote for The National, which explains how the British Empire used currency, the idea of a hut tax, that you had to accept money so you were able to pay the tax. I think this is fundamentally important for the independence movement and for policymakers who are thinking about currency. They understand the value of a currency comes from the need to pay back in taxes. So we've got some other information on that on various SCOTONOMICS platforms, but thanks very much for that comment, Kevin. And yes, Kevin, yes, the Scottish pound may have more value initially. Yep, it may have the same and it may have less. It completely depends on a whole myriad of economic, social, behavioural factors. And to that, we've got a lot more information on that as well. But thank you very much, Kevin. I've not seen you commenting before, so thanks so much for joining us and commenting tonight. Thank you, everyone. Hopefully we'll see you start of August. We've got some wonderful sessions coming up before the end of the year, and we've also got some policy briefs that we're writing, and we hope you can look at and give us your feedback on. So lots happening. Thanks very much for joining us. We'll see you again soon. Thanks. Bye for now.